Hi, I'm Paige Deers. I'm here with Tom Melody. We're talking about the amount of capital chasing real estate. Tom, there's a lot of it, and everybody wants to get into the product type. Why is it still such an attractive investment type?
Well, Paige, I think as you know, real estate has a yield premium which is 100 to 150 basis points higher than alternative investments. And so whether you're a life insurance company or a pension fund or alternative investor, it provides the yield premium that is significant relative to the risk that you're undertaking.
Well, that makes sense because it seems like fundamentals are getting better. So in-place capitals, cash is up, people feel better about the market. Are they getting a little more risky? Are you seeing lenders taking some chances?
You know, obviously, the money the last couple of years has been focused on gateway cities, New York, San Francisco, D.C. What you've seen is the markets like Houston, Chicago, Atlanta, Dallas are coming much more in vogue because they can't get the yields. They're not willing to go into a DC and with a 3.5–4% dividend yield. So I think that you're continuing to see that movement. I think you'll see it more into the secondary, tertiary markets from the equity side. On the debt side, what you've seen is with the continued momentum of the CMBS marketplace, provides an outlet on the debt side, the non-recourse debt side, secondary and tertiary marketplace. And so the yield premium there has gone down dramatically. So I think a couple of years ago what you're seeing was in order to buy an investment in a secondary tertiary market, it would be double digits for sure. And what now, given the cost of capital has gone down, what you're seeing is that the values essentially have gone up dramatically, probably more so in the secondary tertiary markets than they have anywhere else.
Yeah, farther to go up. That's good news. So in terms of the borrowers and the state that they're in, put it in perspective today. Is there more capital today that you've seen in recent years since the height of the market in 2007? Where are we now?
I think on the equity side, especially preferred equity, joint venture equity, I think we've seen more than we've seen at any time in my career, in particular for that product type. The equity for acquisitions, still very attractive. They're having a hard time finding the quality of assets that they tend to be looking for, at least from an institutional standpoint. I think from a debt perspective, obviously you don't have as much debt as you had in the past because the CMBS market is substantially smaller today than it was. And I think one of the reasons that you have the preferred equity and the joint venture equity so available is that you have investors that typically have gone to acquire assets and can't find the product have been willing to say, you know what we want to do is do a preferred equity joint venture position, so we're going to get a, call it 7 to 10% return it's an equity position or a mezz position, and we know we got that yield as opposed to taking a lot more risk and getting the same type of yields on an acquisition.
Well, it sounds like there's no shortage of opportunities for anyone. If you are a real estate holder today, we'll keep looking at that market. Thanks for sharing with us today, Tom.